Hi all, I'm Sham. I have Kishan with me. Welcome to Free Float. Today
Yeah,
we are
hi, Sham.
hey, sorry. Today we are going to be discussing the impact of uh, interest rates, currencies, and the stock market, and how what happens in the US has an oversized effect on emerging markets and India in particular. So we'll start off with a intro. Kishan, do you want to take this away?
Sure. So, Sham, in the last couple of weeks, the markets have been volatile, not just in India, but globally. And, and one of the reasons, like it's like attributed to, is yields going up, which means that, bond prices have fallen, and the yields on those bonds have risen, especially on the long curve. So this might be due to various things. People have different expectations, right? And so the global expectations right now is that we are seeing a strong recovery. From the COVID lockdowns and recession that you had last year, most economies are expected to do to grow very well, and at the same time you have a lot of supply side uh, you know constraints because you have that lockdowns, factories have not been able to produce, demand has shot up considerably for some goods. So a lot of commodities is playing catch up with this boost in demand. So those commodities have gone up, and there's expectation that inflation will rise, and that's also push bond yields higher. Now, I don't know if you have heard this quote, but there's this quote that says, the thing that the person that kings and prime ministers and presidents are most afraid of, bond traders.
Right.
And that's because the government. I think most governments today are running the risk of a high deficit. Um, and hoping that inflation does not spoil the party, and that's the risk that even Indian government is running, that currently. So uh, and I think India especially is more than other countries, because inflation in most developed countries has not been a factor, despite easy monetary policy for maybe uh, 10 to 20 years, or 30 years, like in Japan. It's not been a concern, at least till recently. But India has had this problem of inflation, quite I mean on and off, since ever. So so I think bond. And the second thing is that one is that it pushes up, the cost of borrowing, and and but the more important, and it provides an opportunity cost of like investing in a risky asset versus a non-risky asset, and those things. So it pushes things, but also uh, there is how assets are valued at uh, uh, the way assets are valued is that they are discounted to the present, and the denominator uh, is the interest rate plus your risk factors and stuff. So if the interest rate goes up, then your asset prices will come down, because it will reduce in value. So I think bond yields matter a lot, in the sense that in where we are right now, especially if you see the amount of FI flow that's come through in the last 12 months is incredible. Incredible, and that's the primary factor that moved down the market. So if bond is rise, then you will see a lot of outflow. So that's a risk to the markets.
Well, I think there's a lot to unpack here, right?
Yeah.
So the first thing is the 30-year or the long bond rate taken in isolation doesn't mean anything, right? The most important factor is the rate at which those rates are moving, and the relationship between the long bond yield and the short end of the curve, you know. So where are your 2-year rates trading and where are your 10-year rates trading? So the differential between them gives you an idea of what the market is expecting. Now, I don't think the market um, you know is all 100% betting on high inflation rate. Neither is it betting on 100% reflation, right? Neither is it. So there's another technical angle to this, which is if you look at the mortgage market in the US, right? In the US, there is no prepay penalty. So if you take a 30-year mortgage and rates go down, you can refinance and get into a lower interest rate, fixed rate, without incurring any penalty. So what has happened is, and what typically happens when rates fall, is that people refinance at a very rapid rate. So the mortgage bond that you hold, thinking that you're clipping 5% for 30 years, right? Because rates fall, and it fell to 1% recently, right? Those mortgage bonds get refinanced out. So you get prepaid, you get your principal back. Now, when you
Yeah.
take that money and go to reinvest, you're only getting 2% or something,
Yeah.
on the new mortgage bonds. So there's this prepayment risk. And the inverse happens. So what happens is your 30-year mortgage bond is now the duration of it reduces to 1 year or 2 years because of this. So there's a huge compression in duration. The reverse happens when yields go up. People stop prepaying. Then nobody's an idiot to say I'm going to prepay a 1% loan and replace it with a 5% loan, right?
Yeah.
So what happens is your bonds, your bond duration goes, uh, becomes larger. So one way, portfolio managers hedge this duration risk, the fact that your mortgage bond duration increases, is by shorting treasuries. Okay, so there is also a technical aspect to this as to why those yields may be rising. So it's not just one factor. That's what I'm trying to say. It can be multiple factors at play. So it is not just people expecting higher inflation. So when people expect higher inflation, it is not enough that uh, higher inflation is okay. The key thing is, if the market thinks that the Fed is going to lose control of inflation, right? That is way more important than actual inflation itself, because central banks know how to control inflation within a range. So if it, for the RBI, for example, right, the range is keep inflation between 4 and 6%. The reason why they, that 4 and 6% is not plucked from, from the moon, right? So they did a study and they found that whenever inflation breaks out of that range, it becomes a spiral up, right? People lose control of that fact. So, and that inflation expectations also get baked into households and so on.
Yeah.
So once you lose control of that, then inflation becomes self-perpetuating. So that's why they say they're given a band saying keep it between 4 and 6%. Don't let inflation expectations get out of hand. So that is part of the explanation behind the rise in yields, in that the Fed has indicated that they're okay with more than 2% inflation, or the inflation overshoot, that they call. The reason behind this is fairly simple, because when they made this statement, they were actually afraid of deflation. So they thought that because of all this corona stuff, people are not spending, they are not investing in capital goods and so on. So to kickstart that whole thing, they said, you know what, guys, we're comfortable even if inflation goes 2.5%. So it's kind of like a scary nudge to holders of capital, saying, if you don't spend now, then be careful. We are going to let inflation. We're going to let the inflation genie out of the bottle. But the fact remains that the U.S. economy, the last time it had out of control inflation was in the 1970s. Okay, and that economy is completely different from. Their economy looked completely different from what it looked back then, right? So most of the stuff is no longer manufactured in the US. So at that point in time, US manufacturing was going strong. There was trade unionisms. The whole makeup was different, and most of the market was domestic. So what happened was, wages rose to factory workers at the expense of service workers, and that created a self-perpetuating, inflation. Anchored inflation was way higher, but now those risks are not there, right? um, you know Most people, so there's this joke that if you go to LA, um, everybody is an actress, including your waitress, right? so so it's so that's kind of like the pervasive mentality of US workers right now. It's all like, most of the people are waiting for a break, and during that time they're part of this gig economy. Nobody is part of unions, right? There is no collective bargaining power. So you have all these, 5 different, or a dozen different apps. You just log into them. If work comes, you do it. You get your minimum wage plus tips or whatever, and you kind of tell yourself that you're doing this while you wait for your big break as a rap artist or rock star or whatever, right? So so in this sort of loop that the or culture that the US is in, I don't think um, inflation is going to be that worrisome. But what has happened is a lot of technical factors got together and moved yields up. Another thing is, US became, along with Japan, the Japanese yen, the euro, and dollar joined it as being a source of carry currency. So you borrow from countries where yields are uh, low or at zero, and you invest it in countries where yields are high. So this is your typical carry trade, and it's like a multi-trillion-dollar trade, right? It's a huge trade. And for the longest time, the Japanese yen was a kind of stable source of 0% financing. Then euro joined the party, and now the US dollar also joined the party a couple of years ago. So what you see is partly some of that carry trades being unwound. So as yields kind of started slowly going up, the carry traders kind of freaked out a bit and unwound part of it. So that has a spiraling effect of further jacking up rates. So all these technical factors also contribute to this. It's just not purely inflation expectation. But the problem is, it doesn't matter for Indian investors as to what the real reason of this is. What matters to Indian investors is, if the curve steepens in the US, we are screwed, more or less. If history is any guide, then what happens is, this carry trade that has unwound only a little bit so far ends up becoming a storm,
Yeah.
right? And
So we saw the
unwind
same
at a massive scale means that capital just rushes out of emerging markets. And and India is just lumped with every other Latin American and South Asian country as an emerging market. And traders in London or New York just hit a button, and money just swooshes out. So that has a humongous impact on Indian asset values, and that's what we should be worried about. So there's a lot of chatter saying that this time is going to be different because the RBI has a lot of buffer. They have all these reserves stacked up, so they should be able to do something. But the sheer volume of this and the rate at which capital moves, it's not going to be controllable in any sense of the word. So we have to be wary of people who say that we are going to be fine. We are not going to be fine. And when the unwind happens, we're going to be hit badly, and we should be prepared for it, right? And this nonsense of India decoupling from from all that, some nonsense story, right? It's even my kid won't believe it. So that's not how things work. So you have this move happening, and I don't think it's a one-time affair, right? In my experience, these things happen in waves. So you've seen the yield curve steepening now, like your 10 years becoming really steep, really high compared to your short-term rates, which are at zero in the US. And then obviously there's going to be some sort of retracement where the market the Fed will come out and utter the words yield curve control. Just basically them buying long dated treasuries, and the market will be like, don't fight the Fed, man, buy. Right? So you will see that retracement, and the people who kind of sounded the warning in the first wave will sound like the boy who cried wolf, right? And the market will be like party on. And then the second wave will hit, right? Because the Fed cannot really fight the market. It can only jawbone the market. It can kind of give the market a deal that it cannot refuse, right? But at the end of the day, the market is way bigger than the Fed, and there'll be a second wave. And if they try and do something and it works, then again there's going to be a sense of calm. And the third wave is when the dams break.
The flood will break the dam.
Yeah. So I feel we are still in the first wave, so the markets are spooked to a bit. But what is happening is the Fed is still seen as being all powerful, and they still have the authority to sort of job on the market into lowering these long dated yields. But I would be carefully watching the yield curve to make sure that if it at this point, I feel the US sort of sucks in capital from the rest of the world whenever it's doing good. So a lot of emerging markets park their excess reserves in the US. A lot of household savings in emerging markets are also parked in the US. So if you see the largest holder of US corporate loans, CLOs, right, is Taiwan and Japan. Largest holders. Like small Japanese banks hold CLO debt. The largest holders of corporate credit, US corporate credit, is in Taiwan. Why? Because they create so much excess savings that their local economy cannot does not generate enough assets for those savings to be deployed into, right? So those savings find their way to the US. So when US economy is doing good, and now they're talking about another couple of trillion, infrastructure spending, for example,
Yeah.
right? So that means, like, once this, think of this as a huge ship. I'm not saying it's a Titanic, because Titanic sank at the end of the day, but think of it as a huge cruise liner, right? It's not a speedboat. The US economy is not a speedboat. It can't just turn like this. But once that big cruise ship turns, right, it kind of, along its wake, it's going to carry a lot of speedboats along, right? So you have to sort of, gauge the impact of all this stimulus and infrastructure spending that's going to happen in the US, and see how, that impacts your portfolio and how it impacts global capital flows. And
Right.
the US has always done this. When the US economy is strong, the capital just flows towards there's nothing stopping this flow. And if you think that, India is going to be immune, it's not going to be immune. And does that mean that you should sell all your holdings and, stare at a blank screen? No, that's not what we're saying. But don't be under the illusion that, this is some, the last 6 months that, in India has been some India story and growth and this and
Yeah.
that. No, it's not. Money has come in, markets are up. Money will go out, markets will come down.
Yeah.
And
So what I think we should tell people is not to be too. I mean, not to take not to take excessive of risk. Not to be levered too much, or not to be too aggressive. I think because there risk around the around the bend.
yeah, so the thing is, the timing is always difficult, right? We don't know the timing of this. Now, we've been saying, diversifying, internationally. There are, you don't have to do too much work. Just find some, S&P 500 index fund, just buy that, and diversify into that. Don't be too, aggressive in terms of, like, there are guys who say that, oh yeah, they have diversified into Nasdaq index is not a diversifying instrument, right?
It's a
That's
very
not going
concentrated.
to, that's a very small slice of the whole US market, and that is extremely volatile. So if you really want to diversify, buy the S&P 500 index, and make it a fairly decent chunk of your portfolio, 20 to 30%. You'll not regret it over the long run. And don't be complacent in that, in believing that this is some India growth story, and Indian economy is going to turn around. Look, India will run its own race, right? But nothing great is going to happen in the short term. Everything in India is about 10 years away. There's nothing that's going to happen next year or next month that you need to go and dive into the equity markets and buy whatever you can, right? All these things takes all the measures that have been announced in the budget, and subsequently all this privatization and all that are all great measures, but nothing is going to happen in the short term. These are all long term plays, and there are multiple sort of currents intersect in India. It's not just the government decides to do something and it happens, right? So you have the judiciary, you have all these environment jolawalas, then you have trade unions. So there are a lot of things, a lot of hurdles that need the land acquisition problems. So there are a lot of things, that hurdles that you need to jump before you can call anything a success. And by the time something actually gets done, people would have long forgotten when it was decided that this should have happened, right? So the person who initiated would be long gone. So so not to say that it'll never happen. It's just that it'll take so much time that people will forget who created anything. Yeah. So so don't be in a hurry, and diversify, Don't be in a hurry, and don't panic, because the stuff that is going to happen in the US is going to blow back on everybody, right? In fact, the most recent meeting that happened in the European Union between central bankers of or the financial or the
Yeah.
financial ministers, one of the big risks that they indicated was that if US pumps so many trillions into their economy, then it's going to
Yeah.
suck all the capital away, even from Europe. So it's not just emerging markets and India that need to worry about it. It's everybody. And this yield curve is only one part of it. You'll also see the dollar strengthening as money flows out. So since the corona panic in the markets, the dollar has been falling. um, but you'll soon see that reverse as well. So as money flows back into the US. So these are some of the, I would say, mid to long range risks
Risk.
to the markets. There'll obviously be whiplash and whipsaws, but that's investing for you. There's no formula for this.
All right.
So I hope it will not too long winding, but and we are leaving you with a very touchy-feely, unanswered sort of question. But hey, that's investing for you, right? If everybody had figured this out, then there would be a trillionaire
Agree.
market. So thanks once again for tuning in. We hope that you enjoy our post. And if you have any questions, do leave us comments on our Substack. Thank you very much.
Thank you.